guys, today we'll be talking about the accounting equation and account classification. So what is the accounting equation? It's actually very easy to remember. Basically, it just states that your total assets is equal to the total of your liabilities and owner's equity. Or you could also see it as this. Assets less your liabilities is your equity. Because of this, owner's equity is also known as your net assets, which is your total assets less your total liabilities. But you guys are probably wondering what assets, liabilities, and equity mean. So before we fully understand the equation and how it works, let us first define certain terms. So first are your assets. These include anything owned or possessed by the business. So these are capable of being expressed in terms of money, which are available for payment of company liabilities. So in other words, these are resources owned by the company. It can be further classified into two, namely the current assets and your non-current assets. Your current assets include cash and any other assets that are reasonably expected to be converted into cash or consumed during 1 year or one operating cycle, whichever is longer. So current assets include your cash, investments in trading securities, trade and other receivables, merchandise inventory, and prepaid expenses. Non-current assets, on the other hand, are, as implied by the name itself, those that are not current. They are assets which are not expected to be converted to cash or used within 1 year or one operating cycle, whichever is longer. So for basic accounting students, you would only be focusing on property, plant, and equipment. So let's look closely at current assets. Again, it is comprised of your cash, investments in trading securities, trade and other receivables, merchandise inventory, and your prepaid expenses. So first up is your cash. This is quite self-explanatory since I think everyone has at least seen cash. But formally defined, cash is composed of the currency, coins, and checks of a business invested or received from its customers, either deposited into the bank or not. So an important note to remember is checks are considered as cash. So if ever the problem states that a check was used to pay for, let's say, electricity bills, that is equivalent to paying with cash. So next we have investments in trading securities. So this is a more unfamiliar term for students. These are also known as marketable securities. And basically, these are short-term investments in stocks of other businesses. Take note, short-term. Anything short-term would fall under current assets. Next is your trade and other receivables. These are comprised of whatever collectibles your business may have. Typically, it is composed of your notes receivables, accounts receivable, interest receivables, and advances to employees. Notes receivables are written promises to pay cash to your business. These written promises are also known as promissory notes, which will be discussed in later topics. So these typically, but not always, come with interests, giving rise to your interest receivables right here, which is the amount of interest due on your notes receivable. Again, notes receivables must be classified as short-term, meaning it must be due and receivable within 1 year to fall under current assets. Then you also have the accounts receivable, which are amounts owed to the business by customers who purchased on charge basis. So you may be wondering what the difference is with a note receivable. The main differences are, first, accounts receivable do not involve a written promise or a note made by the customer or the maker. Second, accounts receivables typically don't charge interest, unlike notes receivables. For our trade and other receivables, we have advances to employees, which are cash advances granted and expected to be liquidated in the future in the form of services. To make it easier to understand, Think of your house helper asking for an advance of next month's pay. That would already be classified as advances to employees. And then lastly, we have here accrued income. And I'm sure accrued income is a new term to most, if not all of you. Basically, these are income already earned but not yet received. I know you may be asking what that means, so let me explain the concept further. Think about a business which has sold goods to a certain customer. The customer may take the goods with him while promising to pay in the future. If this is the case, the business has already earned its income because it has already delivered the goods. But at the same time, it has not yet received any payment. So that's basically the concept of earning and receiving. But of course, amounts owed by customers are not accrued income. They fall under accounts receivable. That's just the concept that I'm trying to relay to you. Accrued income would usually come in the form of interest, such as those from notes receivables. Interest on short-term notes receivable are usually paid at the due date. However, the business is actually earning a portion of that total interest every day that passes, even without the actual collection. Thus, the amount of interest income already earned but not received is recognized on the financial statements through accrued income. Interest receivable discussed earlier here is actually a form of accrued income. Next, we have merchandise inventory, which are the goods owned by the business, which are to be sold in the future. So that's a basic concept. And now we have prepaid expenses. So this may seem like a new term to you guys, but you probably encountered these in real life without even knowing it. So basically, these are expenses already paid for but not yet incurred or used up. Here are the common types of prepaid expenses. So first you have supplies, you have prepaid rent, prepaid insurance, and prepaid advertising. I'm sure these are already more familiar to you guys. Supplies are basically materials or other items you use up in the business, such as wrapping paper or packaging tape. You pay for them before actually using them throughout the business, so they are classified as prepaid expenses. Expenses would be incurred when these supplies are actually used in the business already. And then we have the prepaid rent. This would be those rent payments you have already made in advance. For example, rent which was paid for the next 6 months. Prepaid insurance and prepaid advertising are actually very similar to prepaid rent, but these are paid for insurance and advertising respectively. And now that we're done with current assets, we move on to the non-current assets. In this case, we only focus on property, plant, and equipment. Under property, plant, and equipment, we have land, building, equipment, and furniture and fixtures. These are very basic terms, so I won't be defining them anymore, but just take note that machinery and computers fall under equipment, while tables and chairs are classified as furniture and fixtures. But now, to be classified as PPE, they must meet 5 criteria. So first, it must have a physical existence, and second, it must be more or less permanent in nature. Third, it shouldn't be for sale. Fourth, it should be used in the business operations. And 5, they must undergo depreciation. Well, except for land, since it doesn't depreciate. Now that we have finished with the assets, we move on to your liabilities. Simply put, these are economic obligations of the company that they must settle in the future. Again, it's divided into current and non-current. Under current liabilities, we have trade and other payables, while under non-current liabilities, we have mortgage payable and bonds payable. So looking more closely, we have here trade and other payables. So what are your accounts payable? Basically, these are the total amount owed by the business are due within 1 year. Usually when you buy materials, supplies, or merchandise, on a charge basis, you would have your accounts payable. Your notes payable are similar to your notes receivable, only for the notes payable, the business is actually the maker or the one owing the money. So just like notes receivable, to be classified as current liability, the notes payable should be due and payable within 1 year. Interest payable is the amount of interest owed by the business for the amount borrowed. So it's similar to your interest receivable, but it's the interest on your notes payable. And then you have the accrued expenses, which are your expenses which you have incurred but not yet paid, such as your utilities, such as electricity and water. And then you have your unearned income, which is income already collected but not yet earned. So these are basically the advances you receive from your customers. And then we have revenues and expenses. So revenues come in different forms. So these may be from the sale of goods, from gains, or from service revenue. And then you have expenses, which of course are expenses, outflows of the company, like salaries, advertising, rent, and then it also includes your losses. Now that you know the basic definitions of the different accounts and terms, we now move on to analyzing the accounting equation. Again, as I said before, the basic equation is basically assets is equal to your liabilities plus capital. So what do these arrows mean? These show the movement or the relationship between the different accounts. So an increase on the left side would mean a decrease on the right side. And a decrease on the left side would mean an increase on the right side. Now if you look closely on the right side, an increase in your liability would mean a decrease in your capital and vice versa. So let's take a look one by one. So if you see an increase in assets, that could mean an increase in your capital or an increase in your liabilities. It could also mean that there was a decrease in your other assets and have no effect on your liabilities or your capital. Now it's also possible that an increase in your liabilities would mean a decrease in your capital. A decrease in your assets could also indicate a decrease in your capital or a decrease in your liabilities. So that's basically how the equation works. Now remember that the normal balance of assets is debit, so it means that increase on the left side would mean an increase on the right side, while a decrease on the left side would mean a decrease on the right side. On the other hand, liabilities and capital both have normal credit balances, so it means an increase in your liabilities or capital would mean a credit, while a decrease in your liabilities or capital would mean a debit. So here are some possible transactions relating to assets. Take for example the purchase of an asset on account. So if you think about it, you're gaining new assets, but you're not using cash to pay. So you're incurring a new liability without reducing your assets. So it means that the net effect on your assets would be an increase. The second transaction would be a purchase on cash basis. So this means you acquire new assets, but you use cash to pay for it. So in the end, there is no effect. And then third is a sale, whether on cash basis or an account basis. A sale would always result to an increase in your assets, since you'd be increasing either your cash or your accounts receivable. The fourth transaction would be a payment, perhaps of your expenses or a liability such as a loan. So if this is the case, you're using cash to pay, and so there is an outflow of assets, therefore leading to a decrease in assets. And then for an investment, it could cause an increase in assets since you would typically invest cash or equipment and other materials into the business. But remember that this is not comprehensive and may not include all the possible transactions, but these are the common ones affecting assets. As I said before, increases in assets would mean debits and decreases in assets would mean credits. So if you use the T account I have here, you would see that transactions 1, 3, and 5 all causes increase and so fall under debit, while 4 and 2 require a credit or a decrease in assets. 2 also requires an increase in assets and therefore it cancels itself out, leading to a no effect. Here are the possible transactions affecting your liabilities. So for example, you have a purchase on account. So this means you incur a liability and therefore you have an increase. And the next is a payment of a loan. So you're extinguishing or settling the loan, therefore reducing your liabilities. Third is accrual of expenses. So you're incurring expenses without paying for them. So in turn, you have a liability to pay for them, therefore causing an increase in your liabilities. And then lastly, we have the receipt of advance payment, or in other words, unearned income. So again, this is the liability and therefore would cause an increase. Using the same T account, we see the analysis of transactions. So since liabilities have a normal credit balance, increases in liabilities would mean a credit, while the decrease in liability would mean a debit. And lastly, here are the possible transactions for capital accounts. So if you have an investment, you would definitely have an increase in your capital, or a sale or revenue would also cause an increase in capital. Payment of expenses, on the other hand, and drawing or withdrawal of assets would lead to decreases. So again, we analyze it using the T account. Since capital has a normal credit balance, increases would fall under credit while decreases would fall under debit. So now we're going to analyze business transactions using the expanded accounting equation analysis. For example, you have invested 30,000 cash in a computer which cost 50,000 pesos but has a fair value of 40,000. So the accounts affected in this transaction would be cash, computer, and since it's an investment, as I said before, it would cause an increase in your capital. So a computer would fall under equipment. So what happens now is you have an increase of 30,000 pesos in cash and an increase of 40,000 pesos in equipment. Remember that you are always supposed to use the fair value of an investment if it's an equipment and not the cost. So here we use 40,000. Therefore, the total increase in your capital would be 70,000. So how are you gonna journalize this? Again, there was an increase in your assets of cash for 30,000, so you debit. And then there was also an increase in your equipment. Since it's an asset, you also debit it. So that's 40,000. You also have an increase in your capital, which has a normal credit balance, so you credit capital. So that's 70,000 pesos. And there you go, that's your first transaction. So imagine the third transaction is that you purchased 20,000 pesos worth of equipment. Terms 10% down payment while balance on account. So looking closely, we see that there are 3 accounts affected here. First is your equipment, second is your cash, and third is your accounts payable. So the purchase of equipment would cause an increase in your equipment of 20,000 pesos. So the purchase of equipment would cause an increase of 20,000 pesos for your assets. So let's record that here. And then the 10% down payment would cause a decrease in your assets of 10% of 20,000 is 2,000. So this is cash. So that's 2,000. And then you have the balance on account. So this is an increase in your accounts payable for 90% of 20,000, which amounts to 18,000. So to record that, you simply add 18,000 to your accounts payable. There you go. And how do you make a journal entry? Again, since you had an increase in your equipment, you have to debit it since it's an asset. So debit equipment for 20,000. And then you have a decrease in your cash of 2,000. So since it's a decrease in your asset, you have to credit cash. There. For 2,000. And then you have an increase in your liabilities of 18,000, so you have to credit accounts payable. There you go. That's the journal entry for this transaction. Debit equipment for 20,000, credit cash for 2,000, and credit accounts payable for 18,000. Now let's take another example wherein you pay 15,000 pesos for employee salaries. So salaries would mean you have an expense. As I discussed earlier, an expense would affect the capital account by causing a decrease. So let's record that here, a decrease in your capital account. So if you have a decrease in your capital account, you need to have a decrease in your cash or an increase in your liabilities. But in this case, you paid cash for it, so it means you decreased your cash, and so you simply record that. Now, to journalize the entry, you simply make a debit to your expense, which is salaries expense. For 15,000, and then credit cash for the same amount. Take note that expenses always have a normal debit balance, while income always have a normal credit balance. Thus, an increase in your expenses would cause a decrease in your capital, and the increase in your income would cause an increase in your capital. Here's another example wherein there was a sale of goods to your customer. So the sale amounted to 100,000, 50% down payment, and 50% on account. So this means that 50% affected your cash, while the remaining 50% affected your accounts receivable. Of course, both resulted to an increase, as I said before, since sales would normally cause an increase in your assets, whether in cash or on account basis. So 50% of 100,000 is 50,000. So cash and accounts receivable both experience an increase for 50,000. Now, considering the equation earlier, A is equal to L plus C, there must be an increase in your capital or liabilities, or a decrease in your cash. So in this case, there was a sale, and as I said before, sale causes an increase in your capital, and therefore you have to record 100,000 increase in K capital. And how do you record this transaction? So since there was an increase in cash, you debit cash for 50,000. An increase in accounts receivable, so you debit accounts receivable for again 50,000. And then since you have a sale which has a normal credit balance, you credit sales for 100,000. And there you go, that's the entry. Very easy. So for our last example, consider purchasing supplies on account. So again, this is a purchase transaction, so which means you either have a cash outflow or you have an increase in your liability. Since this was on account, it's taken to understand that you have an increase in your accounts payable, and since you purchase supplies, you have an increase in your assets, particularly your supplies. Both for 20,000. So simply record the transaction here. Now it's time to journalize the transaction. So since you have an increase in supplies, which is again an asset, time and time again, you have to make a debit. For 20,000. And you also have an increase in your liability, particularly accounts payable, so you have to make a credit. Now remember that debits should always be equal to your credits, as shown by all the transactions. If it's not equal, then you have to go back to the basic equation of A is equal to L plus C and try to trace where you went wrong. Perhaps there was an increase in assets that you missed or an increase in liabilities that you failed to record. So that's it, and I hope you learned something.